As of the latest market update on August 5, 2026, SMX Security Matters PLC traded at $16.40, reflecting a positive gain of 4.73% during the active session after fluctuating between an intraday low of $15.25 and a high of $17.25. Most investors looking at a microcap ticker like SMX Security Matters PLC see a massive drop from historic adjusted highs and assume it is just another speculative penny stock fading into obscurity. But when you examine what is happening under the hood, the tension between expectation and reality comes down to a classic microcap trap, a groundbreaking physical technology trying to scale inside a brutal public market structure. The surface narrative suggests this company is completely broken due to endless dilution and wild price swings. The deeper reality reveals an enterprise that has secured true technical validation for supply chain transparency, yet continues to struggle with the harsh mechanics of NASDAQ listing requirements and severe capital burn. If you talk to standard traders using a basic online trading setup or browsing Robinhood stock trading forums, the standard consensus is that SMX stock is far too volatile for serious portfolios. People look at the historical chart modified by repeated reverse stock splits and see a stock down over 99% from its theoretical peak. The crowd narrative says there is no value left here. But if you take a contrarian view and look at the market for global supply chain verification, anti-counterfeiting, and circular economy tracking, SMX offers a proprietary chemical marker system that solves a multi-billion-dollar problem. It embeds invisible submolecular markers into plastics, metals, precious liquids, and luxury goods, pairing them with proprietary readers and blockchain ledgers. The market expects total structural failure, but the underlying IP portfolio presents a completely different narrative. To understand how we arrived at today's $16.40 price level, we have to analyze the aggressive trading mechanics that dominate this stock on a daily basis. In recent trading sessions, SMX has experienced sudden massive spikes in daily volume. We are seeing intraday swings where the stock moves 10 to 20% in a matter of hours, driven largely by retail momentum, microcap day traders, and institutional short covers. Because the float is exceptionally tight after structural share consolidations, even modest order flow can send the price soaring or plummeting fast. Institutional activity in SMX remains minimal on major platforms like Fidelity Investments or Interactive Brokers platform options, primarily because mainstream fund managers are constrained by market cap thresholds. Instead, the order flow is dominated by high-frequency algorithms exploiting low liquidity and retail momentum traders placing quick orders through SoFi Active Investing or Robinhood app tools. Earnings reactions and financial filings paint a sobering picture of the operational reality. In its full-year financial reports, SMX logged a steep net loss of $169.18 alongside negative operating EBITDA of $130.44. That kind of cash burn generates immense pressure on the balance sheet. However, cash flow figures showed a surprising net inflow of $9.86 million, signaling that capital raising efforts and targeted financing rounds have kept the lights on while management works to commercialize its tech. The market hates ongoing net losses, and every time earnings are released, short sellers attack the stock. Yet every announcement of a strategic partnership or commercial proof of concept creates short squeezes that send retail traders rushing in on their favorite trading apps. Sector momentum is both a tailwind and a headwind for SMX Security Matters PLC. The broad industrial and technology sector is leaning heavily into sustainability, ESG compliance, and supply chain provenance. European regulations demanding recycled plastic content and full trace and track transparency for consumer goods create a massive target market. Macroeconomic pressures, including elevated interest rates and tight credit conditions, hit microcap growth companies hardest. When money is no longer cheap, companies without immediate large-scale profitability get punished by the market. This is why SMX trades at a market cap of around $16 million despite owning technology that addresses global industrial supply chains worth trillions. Let us pull back the curtain and look at what SMX actually does as a business. Headquartered in Dublin, Ireland, SMX provides brand protection, authentication, and track and trace technology. Its core solution uses chemical and physical markers embedded directly into raw materials, whether solid, liquid, or gas, at the molecular level. These markers survive melting, manufacturing, and recycling processes. A specialized proprietary reader scans the material, reads the embedded code, and uploads the data to a secure digital platform. This creates a permanent digital twin of physical goods, ensuring that companies can verify whether a product is genuine, sustainably sourced, or properly recycled. From tracking gold and rubber to luxury fashion and recycled plastics, the company's business model relies on licensing fees, marker sales, and subscription-based digital verification services. The history of SMX on public exchanges has been a wild ride. Emerging as a public entity via a SPAC transaction, the stock faced immediate structural selling pressure. Early investors dumped shares, and the company struggled to generate meaningful commercial revenue fast enough to offset public company overhead costs. To stay compliant with NASDAQ's minimum bid price rules, the company had to execute structural corporate actions leading to massive split ratios that compress share counts and warp historical price charts. When you see historical 52-week highs listed in thousands of dollars, that's a mathematical artifact of repeated reverse splits, not a price where investors were buying shares in the open market. Now, ask yourself a question about where this technology is heading. Comment below how many shares of SMX you currently hold, or if you think supply chain tracking technology will become mandatory for major brands in the next 3 years. Looking ahead, the future outlook for SMX relies entirely on execution versus funding. The market expects ongoing dilution, weak cash conversion, and perpetual risk of delisting. That's the realistic downside risk. But the potential catalyst lies in large-scale enterprise adoption. If a major global tire manufacturer, luxury conglomerate, or chemical producer officially standardizes SMX's molecular markers across their entire global production line, the commercial revenue model changes overnight. In that scenario, the market reality shifts from a struggling microcap to a high-margin technology provider with locked-in corporate contracts. Whether you manage your own portfolio through self-investing options, use a robo-advisor like Schwab Intelligent Portfolios, or trade actively using interactive brokers trading tools, microcap tech stocks like SMX present a classic risk-reward trade-off. On one hand, you have severe financial headwinds, negative margins, and dilutive risk. On the other hand, you have proprietary technology sitting right at the intersection of supply chain security, anti-counterfeiting, and global regulatory mandates. In summary, SMX sits right at the crossroads of market expectation and operational reality. Wall Street views the stock as a distressed microcap asset burdened by historical capital burn and heavy dilution. The reality, however, shows a specialized firm with valid IP, expanding corporate partnerships, and a clear product-market fit in an increasingly regulated world. The gap between what the market prices today and what the technology can deliver remains wide, making SMX a ticker to watch for anyone tracking high-risk, high-reward supply chain tech. Disclaimer: this video is made only for educational and informational purposes. I am not a financial advisor. Any stock, crypto, or investment discussed here is not financial advice. Please do your own research or consult a qualified financial advisor before making any investment decisions. Invest responsibly.